4 perfect ETFs to make money. So Vanguard has a number of exchange-traded funds, or ETFs, that are perfect for those seeking low-risk investment income. ETFs give you the instant diversification that's almost impossible to achieve by handpicking your own stocks. And the beauty of Vanguard ETFs is that they have some of the lowest fees out there. Now, here are 4 Vanguard funds income investors should seriously consider. Number 1, Vanguard Real Estate ETF VNQ. The Vanguard Real Estate Investment ETF, which also the stock symbol is VNQ, offers a way to invest across the entire U.S. real estate market without buying up physical property. This is basically more for people who don't want to bother with real estate or have too little money. So it invests mostly in equity real estate investment trusts, or REITs, which own and operate income-generating commercial real estate. Investing in REITs is a savvy move for income investors because they're legally required to distribute at least 90% of their taxable income as dividends. The fund also includes a handful of real estate development and management companies. So with $61.4 billion in assets, it's by far the largest real estate ETF in the U.S. The fund has an expense ratio of 0.12%, which is cheaper than 0.48% average for other REIT ETFs. A 0.12% expense ratio means that just 12 cents of every $1,000 you invest is going toward the fund's management fees. The VNQ has an enticing dividend yield of 3.31% as of January 31st. That's more than double the 1.53% that the S&P 500 offers. Number 2, the Vanguard High Dividend Yield ETF, stock symbol VYM. So the Vanguard High Dividend Yield ETF is the most popular dividend ETF in the U.S. It tracks an index of 410 companies, with REITs excluded, based on their dividend forecast for the next 12 months. Its 5 largest holdings as of January 31st, 2021 were Johnson & Johnson, JP Morgan Chase, Procter & Gamble, Bank of America, Intel. Although the fund doesn't specifically screen stocks based on risk, it tends to be less risky compared to the broad market. That's because companies that consistently pay dividends tend to be relatively stable. The fund's dividend yield is 3.05% as of February 28th. But it also offers decent potential gains. As of that same date, the ETF delivered a 1-year total return of 19.68%. And I've basically shown this before in a previous episode, but pretty much you could get any basically index fund of the stock market and you could pretty much see that it's going to grow over time, right? As long as it's like kind of like overall in either in a whole sector or basically covering almost the whole stock market, an index fund is pretty much going to do pretty well. So it has an expense ratio of just 0.06%, making it a bargain compared to the 0.41% average for similar funds. Number 3, Vanguard Dividend Appreciation ETF, stock symbol VIG. The Vanguard Dividend Appreciation ETF invests in companies that not only pay dividends, but also have a history of increasing their payments. It tracks the NASDAQ U.S. Dividend Achiever Select Index, which consists of 212 stocks known as dividend achievers because they have at least 10 years of consecutive dividend hikes. The VIG's 5 largest holdings as of January 31st were Microsoft, Walmart, Johnson & Johnson, Procter & Gamble, United Health Group. Stocks with a history of increasing their dividends are attractive to retirees, who are often hit hard by inflation. For investors in general, though, a steadily rising payout is appealing because it indicates the company's finances are stable enough to support that dividend growth. The VIG also has a super low expense ratio of 0.06%. Its yield of 1.66% is lower than the Vanguard's high dividend yield ETF, but 1-year total returns as of February 28th were higher at 23.62%. And number 4, Vanguard Value ETF, stock symbol VTV. The final fund to consider if you're seeking a low-risk investment with solid income-generating potential is the Vanguard Value ETF. The fund tracks the CRSP US Large Cap Value Index. The index starts with stocks that make up the top 85% of the US stock market by market capitalization. It then uses metrics such as the price-to-book ratio, earnings to price, and dividend-to-price ratio to identify value stocks which appear to be underpriced. Income investors tend to like value stocks because they typically have stable revenue and earnings, and most pay dividends. The fund consists of 328 holdings, the largest of which are Johnson & Johnson, Berkshire Hathaway, JP Morgan Chase, Procter & Gamble, United Health Group. The VTV's 1-year total returns were 21.34% as of February 28th, and its dividend yield was 2.44%. The expense ratio is the lowest for the ETFs discussed here at 0.04%. Like the other funds on this list, the VTV doesn't offer huge growth potential, but the stability of its holdings and its low fees make it a strong choice for those seeking investment income. Feel free to become a member, support this commentary in the description. Check out 40inbox.com to master your money, personal finance lessons, personal finance courses. Contact us with your personal finance question or story. You can also click in the description below and join Robinhood and just buy some of these ETFs if you're interested in more of like an income producing type of investment strategy. Now the thing is, some people might wonder, why would you even bother with dividends, right? Because you could obviously get more growth potential from other investments. The thing is, people need to understand that personal finance is personal, right? So you might be in a specific situation where you don't necessarily care too much about the growth potential, but you care more about how much money am I going to get every single year. Like a good example is that I was watching a video about someone who is focusing on just dividend stocks, right? Now, the reason why I'm bringing this person up is because they have to invest in a very specific way for a very specific goal because of their specific situation. And to keep it like a rough summation of his situation, this person has a decent amount of money. They have very serious health issues, and their partner, their wife, has basically no understanding of personal finance or investing and doesn't want to bother with it. But they are in a very real situation that pretty much at any time, he, basically the sole breadwinner, will pretty much potentially just pass away. Like, snap of the finger, gone, right? So he has to invest his money in a way to where the investments will provide her with a full-time living without too much stress. As in, basically set up all your investments into basically a dividend stock portfolio to where all the dividends get sent to a specific bank account, and she's just able to check how much money she has and basically, deal with taxes by just having an accountant, basically look at the data and basically be able to pay her taxes that way. Because also another side of this is that apparently if she has some sort of windfall or like a large sum of money, she will immediately spend it. right? She has a hard time of managing her finances, which she's honest about, right? Which means she needs like regular amounts of money coming in on a regular basis that is not too massive, in the sense that like it's not like at one time she's going to get like $100,000, right? Like if you were to like sell a stock, right, in your retirement years, right? She needs something that is a regular amount of money coming into her account pretty much on a monthly basis, saying like, okay, this is how much money I have to spend, right? Some people have to structure their life that way because they can't have, like, they just don't have that self-control, right? And as long as they're honest about it and they're able to put in the steps to set it up, that's fine. But the thing is, that's why some people might be more interested in a more income producing investment strategy. Because again, people have to understand this, and I'm repeating this. Personal finance is personal. So it's different from each person. Yes, there is a foundation that you can follow, but again, no one is living your life. So you have to structure it in the best way for your life. So keep that in mind.